Hi guys, it's real estate broker Maureen Folan here with the Maureen Folan Real Estate Group. I've been selling homes in Queens for over 25 years. So today I wanted to bring in a very good friend of mine who is a direct mortgage lender. His name is Robert Yusupov. He's been selling loans for over 25 years, and we're gonna have a conversation today of what is going on with the mortgage rates, what is happening in this recession, how people are financing their homes, and all of these burning questions. So stay tuned. Robert, thank you so much for joining us. You want to tell us a little bit about who you are, what you do, and what you're qualified to speak on here today?
Beautiful. Yes. So I'm a mortgage lender, basically a lender with an option to broker. And what does that do? What is the difference? A lot of people ask, why should I go to a mortgage lender? Why should I deal with a broker as opposed to going directly to a bank? And I've been doing this for similar to the amount of time that you've been doing it, over 20 years. And we realized that everything ties into the needs of a person. And what can we do is, whatever the needs of a individual that's buying or selling or refinancing their house, we have to match them to a bank that has the guidelines to meet what they're looking for. And the guidelines are ever changing. Whether we're in a recession, whether we're in a good time during COVID, guidelines just continue changing. And you have to learn those guidelines, you have to study those guidelines, and you have to make sure that those guidelines somehow match to the client, the seller, or whoever it is that's looking for the mortgage financing. And this is where I myself and my team, this is where we take pride, because we have to deliver an experience. We have to deliver, it can't just be all about a computer doing all it. It's the biggest financial decision that a person is making. They're taking out a lot of money. I always say, you're not buying a refrigerator, you're taking out a lot of money. You have to make sure that you're dealing with the right person. You have to make sure that you're dealing with an individual that understands the needs of what you're looking for. It has to be specific to the needs of every single individual, because not all people aren't all the same. Everybody has different incomes, different credit scores, and that's why we take an approach for the financing specific to everybody that we speak to.
Right. Absolutely. Fantastic. Okay. So, with all the uncertainty in the market and interest rates more than doubling in the last year, I mean, that's the first time we've ever seen that in history. I'm sure you're seeing it in the markets that you're working in. There's been a little bit of a cool down. I know there's been less transactions, definitely in Queens. In terms of pricing, there hasn't been much of a shift in terms of numbers, but definitely less transactions in the marketplace, just because I think a lot of buyers and sellers are just kind of waiting to see what happens. So talk to me a little bit on what you're seeing in the Florida market, New Jersey market, in terms of number of transactions and buyers and purchase power.
It's a great question. The interest rates did bring a lot of people to the realization that we can't afford now the way that we were able to afford before. As I'm looking at a tax return of a X amount of income qualified you for X amount 2 years ago. That tax return no longer qualifies you for the same exact amount, because it's just not enough based on the interest rate and amortization of the loan. So to offset that, banks have been coming up with a lot of different creative options. I'm sure you've heard one of them. It's called a 3-2-1 Buydown.
Yes. Can you just talk a little bit about that? Are you selling a lot of those kind of loans to buyers?
You have to understand the product. And for a person that understood the product, we've closed a handful within the first, when the product was released, within the first week, we sold 3 loans. And as we kept going along, we funded over 53-to-1 loans to people that understood the product. And why it made sense at that particular time is because for a person that was looking at a monthly payment with a new rate compared to the old rate, they said, you know what, for the next year, I could have a lower monthly payment. The year after that, I'll have a lower monthly payment. It doesn't have to feel like a shock to where the mortgage rates are today.
Okay.
So yes, even though the interest rates changed, for a person that was looking to buy, the interest rates didn't really prevent them.
Right, because there's different options in the marketplace.
Say it again, I'm sorry?
Because there's different options that buyers can choose from in the marketplace that can offset these higher rates, and they can still afford their monthly payments.
Absolutely. As you know yourself, Maureen, interest rates went up, rental payments go up, but people still need a place to live.
Right.
People will still need a place to buy. And as interest rates go up or rental prices go up, a person's going to buy, they understand that the interest rates will cool off at a certain point, and then you could always refinance with no penalty, without any fees, and be able to come back to a lower monthly payment. However, you're growing the equity. you're
Right.
still building equity that you wouldn't have as if you were to be continuing with a rental.
Right. And you're also getting all those tax deductions that come along with home ownership. So
So
that
true,
makes
so
sense.
true. That's like
So,
an icing on a cake.
right, of course. So let me just ask you, for those that don't know, what's the difference between a mortgage broker and a mortgage banker, and why would one work with one over the other?
Great question. A mortgage broker takes an application, takes documents, and just shoots it off to one bank, shoots it off to another bank, and then you depend on the underwriting from that particular bank to
Mhm.
approve the file, to work on the conditions of your file, or eventually deny the file because they didn't like something. So you really have no control over a file.
Okay.
With a mortgage banker like myself, we underwrite the file ourselves with all our underwriters. Like my underwriter is down the hall from me. I could always walk down the hall and go over a particular scenario. It gives you a lot more leeway and a lot more understanding of what can and can't be done. So
Okay.
we underwrite, we process the file ourselves, but we do it to the guidelines of other investors. Meaning, if a person walks into a bank today to a bank that they use checking and savings with. If a person does that, then you're stuck to the guidelines of that particular bank. And your
Okay.
file's probably being underwritten somewhere in Ohio or somewhere in a remote location, and you're nothing but another file. We take the approach of we have 33, 34 different investors, hedge funds, banks, Wall Street, whoever secondary is. They all have guidelines that conform to Fannie Mae and Freddie Mac, where they have their own guidelines if it's a jumbo loan. And we fit this particular file to the guidelines of that particular investor. And
Okay.
this gives a lot more flexibility, a lot more options, and a lot more rates than you would as if you were a
As a
broker.
typical bank like Chase or Wells Fargo.
Correct.
And what does it mean in terms of financing for the buyer? Like what does it cost to go with a mortgage banker versus the traditional bank?
We, like traditional banks, we don't charge any fees. We don't have any broker fees. We don't have to charge you anything. We don't charge you any points as a service because we are getting paid by the bank for completing the work. We
Okay.
don't get paid until the loan is closed. So it's in our best interest to make sure that everything is done properly so that you're happy and you're closing on time.
Right.
And as far as fees, you're not overpaying, but you're getting much more service and you're getting a better product
Right.
when dealing with somebody like myself, a direct lender, as opposed to going to a traditional bank or working with a broker.
Okay. All right, that makes sense. And let's kind of get into mortgage payments. How do you calculate a mortgage payment? Like for the average buyer who's, thinking about buying a house in 2023, what should be their first step in trying to figure out financing, getting pre-approved, what their income should be? Like what would be number one? Like what would you advise a buyer to take action on?
The worst thing that you can do is go on Google and say, how do I calculate a monthly payment? Because there's so much that comes up, there's so much noise that pops up where you just get confused. Am I calculating it correctly? Is the monthly payment being done the right way? Am I putting in the correct interest rate? And it gives a lot of false and incorrect information. And when you have false information, you have false hope, and that can prevent you from buying a house, or that can get you to buy a house that you can't even afford. So
Right.
my suggestion is speak to someone who is a professional who can calculate the monthly payments for you. There's a ton of calculators online. I have calculators. You can use a calculator on the app, but it doesn't mean that those calculators are giving you the right information. The math behind it is correct, but how do you know what interest rate to plug in? How do you know what loan amount to put in? How do you know how many years to put in? That will all make a determination whether you really qualify or you don't. So I think it's best to connect to someone who has good reviews, who has a good online presence. Talk to them, see what you could really qualify for. We don't charge for consultations. It's not like
Right. So
attorneys
it
or
makes sense
doctors.
just to kind of speak to a professional who can guide them and point them in the right direction because there's so many
Absolutely.
nuances. Same thing when selling a house. There's so many different, it's not just cookie cutter, one size fits all. There's lots of different
Absolutely.
programs and ways to go about achieving the goal. So let's talk a little bit about the current state of the real estate market. What are you seeing in terms of transactions when it comes to Florida?
Florida still has a lot of demand. There's still a lot of people that are moving from New York, from California, from Texas. As long as there is demand, there will be sales, and there will not. We're not seeing decrease in prices. Now, are we seeing properties that are on the market for 2-3 days the way that they used to? No, they're on the market a little bit longer because the pool of buyers isn't as big as it was 2 years ago because not
Right.
as many people can qualify. However, the demand is still so strong. People are looking to invest their money. People are looking for a summer home. People are looking for a vacation home. Airbnb has created such a great opportunity for Florida where if you're not living here, you could just Airbnb the property and they'll pay all your expenses.
Right.
And everybody has a way to find a management company that'll Airbnb or VRBO or rent out your property if you're not using it. So it became like a safe haven for your money.
Right.
A lot of South Americans, a lot of people outside the US are investing into these new luxury condos because it's a good investment. You know that your money is safe.
Right. And there's always a demand. There's always people that want to go to Florida, different parts of Florida for the events going on, for the nice weather, to snowbird if you want to get out of the cold Northeast for the winter. And it's such an easy trip, right? Everyone always wants to go to Florida. So
true.
The market that's always people always coming and going. What are you projecting for the 2023 rates? Like right now we're somewhere like between 6 and 6.5%. Where do you see rates going for the remainder of 2023?
There was a great article that was posted at the end of 2022 saying that interest rates are going to be hitting 4.5% by mid to end of 2023. Historically, I could, I have a chart. Can I share a chart real quick?
Sure.
Let me share this chart. One sec. Let's take a look at this. So mortgage rates and recession. Are you seeing this?
Mm-hmm.
Where interest rates were in the 80s, look at that. We were seeing 18 to 13%, incredible. Then interest rates started dropping. We've seen the 375, the 275 in the 2020 during COVID.
Right.
You could see that interest rates are somewhat similar to what they were 2014, 2015, 2016, which is in the fours, which is what's considered to be the new, which was normal. The 2 and the 3% interest rates that we were getting, not necessarily something that's normal. It was something that's for COVID time. It will never happen again.
It was a blip in history. So those days are gone.
Such a blip. Exactly.
And I don't know if we'll ever see that unless we have something like COVID again. That was the government's way of stimulating the market for people to buy. So those days are gone.
There was so much money that was printed. The Fed just kept buying. And to a certain point, it's like, okay, we have to stop buying at a certain, otherwise you're just devaluing money even more. So interest rates are going to be in the fours. As a matter of fact, we've all been hearing about the interest rate hikes that the Fed is doing. The Fed raised the rates again, the Fed raised the rates, and that negative news was never really explained to homeowners what it really means. Just because the Fed's raised the interest rates doesn't mean that your mortgage interest rate is going to be higher.
Right.
Your home equity, your credit card, your auto loan will be higher, but your mortgage payment, your mortgage doesn't necessarily tie into that. There's a 10-year treasury that is a very good indication as to where the mortgage rates are going. For the last 2 weeks, we've been seeing that the rates have come down a bit because the CPI numbers that have come out, which is something that the Fed is doing to tame inflation. So every time Feds raise the interest rate, they were doing that to basically tame inflation. And their goal is if they can get inflation under control, we're going to start seeing interest rates come down again.
Right.
That's the first set of good news, is that the CPI numbers have been under control. The second set of good news is that interest rates always is just historically, if you look at it before elections, interest rates always come down.
Yeah.
So knowing that we're going into election season in 2024, whoever the president is, whoever is taken, it doesn't matter. Interest rates have always been known to come down, stimulate the economy, because real estate creates a lot of jobs, creates a lot of opportunities. And when real estate is doing good, there are so many industries around it that are doing well at the same time. So we know that by the end of this year, for certain, we're going to start seeing lower numbers than we are right now. However, the house prices will not be as low.
Right. Well, I'm seeing in my market that the prices are not really dropping, but if buyers are, that's the big thing. Buyers are like, well, I'm going to wait. I want to see what happens with the interest rates. But guess what? If the rates drop like you're projecting, there's going to be an abundance of buyers in the marketplace. And that's when you're going to see the prices go nuts like they did, for the last couple of years. So for those buyers out there, it is such a good time to buy because, like you said, you could lock in on the house that you want today. The sellers are a little bit more flexible because they know that there's less buyers in the marketplace due to affordability. But if they lock in today and find the house they're looking for and get it at a bit of a better deal than what they were getting at a year or two ago when they had to bypass all the contingencies and pay $100,000 over list price, they lock in today, they could always refinance in 6 months' time, a year's time, if and when those rates go down. So that's the message that we're giving to the buyers, that it's actually a great time. You don't want to buy when it's wild and the houses are 100,000 over list price and 15 offers. That's the worst time to buy. So we just came out of that. Why would you be waiting for that again, right? And there's no sign of any kind of unemployment. I mean, people have talking about this big crash that you're seeing, that you're going to see in the real estate market. But the difference between now and 2009 is that in 2009, there was a lot of unemployment. It was the biggest financial crisis since the Great Depression, but we're not seeing that in my market. And I'm sure in markets like Florida, people came in and bought all cash, put in good down payments. Same thing in Queens. People are putting down 40, 50% in North Queens to buy homes. Those people are not foreclosing on their house. And the other people that have been living there, they've been living there for 20, 30, 40 years. There's so much equity in their homes. I think it's like 48% of homeowners in the country don't even have a mortgage on their home. So that crash that people are waiting for, I think they might be waiting a long, long time. They're waiting.
Maureen, those are the people that have been waiting, and they're going to continue to wait. I don't have to tell you this, you would know, but you can never time the market. You could only time in how long you're going to be in the market. It's like you buy a house, how long you're going to hold on to it. But it's like if a needle is dropping, right? If you have a pen that's falling, how do you know when it's going to hit the floor? Can you really catch it? Or can you try to, in the middle somewhere, attempt to catch it while it's falling? It's the same exact thing with homes. How can you know when you're going to hit rock bottom?
You don't know until 3 months later, because that's when the data becomes public. And at that point, it's already gone. Like 3 months ago, you've already missed the point, right?
Exactly.
So you don't. I always tell people you're ready to buy and sell when you're ready to buy and sell, meaning that if you want to buy, you need to buy, you're having a baby, you're upgrading, you need more space, you have a solid job, you plan on being in the house the next 5 years, and you can afford that monthly payment. It doesn't matter what the rate is. As long as you can afford that monthly payment, then that is the time to buy. But, and the same thing selling. If you can afford to sell and you want to move and you want to retire, instead of trying to time the market and, oh, I want to sell next year, I'm getting $100,000 more. You don't know that. You don't know that. And why would you wait? Because nobody knows what's in store tomorrow, right? Like if you can afford to make the move, if you want to make the move, then make the move. Don't do it. I'm not saying doing it willy-nilly and not educating yourself and being prepared, but trying to time the market. Good luck. Good luck with that.
Speaking of recessions, in the last 6 recessions, there has only been one time, which is 2008, like you mentioned, that home prices actually fell. If you look across the United States, some areas get hit more than others because they went up much faster. But if we're looking at 6 recessions, 2008 was a time you can't compare to any other time. I mean, banks weren't lending. It was a financial crisis worldwide. So for people to sit and wait, it's better to take an opportunity, make offers to sellers. I've done a whole chart where even with a 7.5 interest rate compared to today's interest, I'm sorry, with a 4.5 interest rate compared to today's interest rate, you could still negotiate and have a lower monthly payment at a time like today than you would 2 years ago, because you're not, like you said, you're not overpaying for $100,000 for a house. You're not going into a house with no contingencies. Like I have to waive the appraisal contingency, the mortgage contingency. You can get all those contingencies. You can negotiate for a better price. Yes, the interest rate will be slightly higher, but your monthly payment will still be lower. And 6 months down the line, you'll refinance. Like I'll call you myself to tell you you'll refinance. We'll do an automatic refinance, no cost to you. It's a win-win situation.
Yes.
But at least you bought at the right time.
Exactly. I agree. All right. So let's talk about like ways to get reduced mortgage rates. Like a buyer in the marketplace, what do they need to prepare and what do they need to be doing to get the best possible rate when they purchase their home?
So this is something that is so amazing. It came out a couple of days ago. Fannie Mae and Freddie Mac, the biggest mortgage holders in the United States, they pretty much, we don't hear much about them. Like if you're buying a house, you could see on the mortgage statement a different name. That different name is just the servicer who you're paying the mortgage to. However, at least 90% of mortgages in America are owned and held by Fannie Mae or Freddie Mac, who after 2008 became government entities. Fannie and Freddie just came out that they are waiving, and this is so beautiful, anybody that's a first-time home buyer, right? And what's a first-time home buyer? You haven't owned the property in the last 3 years. That's technically the definition. But if you're a first-time home buyer, they're removing all loan level price adjusters. It's called LLPAs in our industry. What's a loan level pricing adjuster? Is that before, if you had a 740 credit score, you would get one rate. If you had a 720, 700 credit score, you get a different rate. If you had a 660, you get a different rate, because there's just all these hits because of your credit score. So now that Fannie and Freddie has removed that for first-time buyers, a person with a 660 credit score can get the same rate as a 740 credit score. It's incredible. You don't get hits anymore.
Mm-hmm.
So you could get into a house with a 3% down payment, which can be gifted to you, 3% down payment. And if your score isn't perfect, yes, we can work on getting your score perfect. But some people you talk to, they're like, oh no, I have to wait for my credit score to go up. That can take 6 months, that can take a year. Why wait?
Mm-hmm.
Especially when they're saying that your credit score is no longer a hit to the rate.
Right.
That means you will be treated the same as if you have a 660 or 720. Why would you wait to buy a house?
Mm-hmm. Mm-hmm.
It's just an opportunity that they're given. So as far as the rates are concerned, depending on where you're buying, depending on the neighborhood, depending on the state, there's something called a conventional conforming loan size. New York has something called conventional high balance that goes up to about 1,089,000. And then anything above that, it goes jumbo. The rates on jumbo aren't dictated by Fannie Mae or Freddie Mac. It just depends on your overall financial standing, how much you have, how liquid you are. That can determine the rates. But the better the down payment, usually that has somewhat of a prediction of where your interest rate is. But it doesn't necessarily mean that you have to put 20% down payment. It's not a necessity. You could do as little as 3% down payment. Credit score has always been a factor
Mm-hmm.
up until now if you're a first-time buyer, and you just your income. Debt to income ratio has to be at a certain number. So as long as you have those three criterias, you're getting a phenomenal interest rate, whether it be an adjustable, whether it be a fixed. Look at all your options as
Right.
far as interest rates, as far as programs, and then pick the one that makes most sense for you.
Right. Okay. That makes sense. Okay, good. And let me ask you, in our market, we have a lot of multifamilies.
Mm-hmm.
How do multifamilies work in terms of loans? Like the additional income from the tenant gets
Mm-hmm.
considered income in the
Mm-hmm.
bank's eyes?
Correct. Yes. So if you have a two-family house, let's say you're going to be occupying the first floor, the second floor is a rental. Whatever the rentals are in that area for a similar type of a property will be considered in the bank's eyes as potential additional income. So if you have a property that's going to be collecting net $2,000 a month, that's an additional $24,000 income that you could be given for qualification. There's something called border income, which a lot of banks don't use. I don't know why, but border income is you could rent out partial basement. You could rent out a partial, some houses are like a mother-daughter, where
Right.
it doesn't have to be a two-family house. It could just be a basement that has a rental that has a separate entrance. You could get 30% of that to help you with the income. So
Isn't that
the
illegal?
more, yeah, there's just so many ways to qualify a person. It's just the person has to have the will and the want to buy,
Right.
and then
There's many
and then we
different
figure
avenues.
out ways.
And that's why
Absolutely.
speaking with the right direct lender is going to point you in the right direction of the program that
Exactly.
best suits your needs.
Exactly.
Okay. So let's talk about types of loans for self-employed people. How does this affect getting financing when you're self-employed?
I love self-employed people. They make so much money and they don't want to show anything on tax returns. Of course. It's like if you have a way of not paying Uncle Sam the taxes, why not? But banks have figured out if there's going to be a need for that type of a loan, we'll create different products. So there's something that came out called a non-QM mortgage. Non-QM mortgage doesn't necessarily look at your tax returns. There's two ways of how to qualify. There's actually more than two ways, but non-QM says either we can qualify off of the rental income that the
Mhm.
property has. So technically, you don't even need income. So if you want to buy a four-family house and you have four rentals as an investment, you could use those rental incomes. Let's say it's $2,000 each, right? We'll go back to the 2,000 number. That's $8,000. As long as that $8,000 covers your monthly payment, you don't even need to have a income
Right.
to qualify.
Mhm.
It's unbelievable. Another program is there's asset-based mortgages. So if you have, let's say, $1 million in the bank that you're not using for the down payment or it's in a retirement account, there's ways that I could use that $1 million assets to qualify you without you showing your income.
Right.
That's another
Okay.
self-employed product. There's a P&L product. So P&L product is you don't necessarily report all the income, but you made it. So basically, accountants will do everything to write off as many expenses as possible so that you don't have to pay a lot of taxes. We could look at a profit and loss before all the deductions and qualify you off of that number before you do all the write-offs.
Okay. All right.
Option
So
number
there's
three,
many different
something that's
options
become
for self-employed.
there's one that has become very, very common is called the bank statement program. Bank statement program is we look at 12 months of your business bank statements. We look at all the transactions that you receive, all the deposits that you receive. Deposits are looked at, withdrawals, not as much. So if you're a business that has a lot of deposits on a monthly basis and consistent, we could use that as an income to qualify you.
Okay.
Again, so many opportunities.
Again,
Just
get to the right direct lender is going to
exactly.
point you in the right direction, but there's opportunities there for
Yes.
self-employed people. What about PMI insurance? Can you please explain what PMI insurance is and
Yes.
what is the minimum down payment for PMI insurance?
So there's the old general rule was if you don't put down 20%, you will have PMI. PMI is called private mortgage insurance. PMI, however, does go based on your credit score. The higher the credit score, the lower the PMI is going to be. And the closer you get to that 80% financing number, the better chances that your PMI is lower. PMI is a very interesting topic. PMI, depending on your income, depending where you live, PMI could be fully tax deductible, a full write-off. PMI doesn't last forever. PMI lasts up to 5 years or until you build up at least 20% equity in your property. So PMI is a separate type of insurance. It's not given by the bank. It's a third-party company that does it to ensure the bank that if for whatever reason you default, there is an insurance. Just like there's an insurance if you fall, there's an insurance. For everything that we have, a car accident, for everything there's an insurance. This gives a leverage to the bank that if a person's putting down less than 20%, we got them.
Okay.
Well, banks have got creative since. Banks said, you know what if we give our clients 85% financing with no PMI? It's just a way to attract clients. So even if you put 15% down payment and you have a good profile, you can avoid PMI. Here's something very special about New York that a lot of people don't know. And this is, I would say this is going to apply for our next couple of months because of sales that happened 6 months ago. As you know, appraisals will go off of sales in the last 6 months.
Mm-hmm.
If there was a high price appraisal of a house that sold, let's say a house sold for 800,000 6 months ago, and then somebody finds a house on the same exact block or within the vicinity, and they negotiate it to 750, right? Which happens nowadays. When an appraisal comes, the appraiser says, you know, there was a sale for $800,000, so now this house has a chance of appraising for 800 as well. If you can appraise 20% and you have that equity 20% of your purchase price, you can close without PMI, without a 20% down payment.
I see what you mean. Okay.
Only in New York.
Interesting.
But you could close without PMI, even if you have a 10% down payment, depending on what the property appraises.
Right. Depending on if there was similar homes in the area that sold for that price. Okay.
Correct.
All right. That's interesting. What is your average loan processing time? And why does it take a lot longer in New York than it does in other states?
The truth is the attorneys. It's all about attorneys. Florida is not an attorney state. It's a title state. So a contract gets drafted differently. It gets put together by a real estate agent. It goes to a title company. In Florida, 14, 15 days, you could have a transaction from start to finish, assuming that the seller is vacating the property, assuming the property is ready. 15 days, 21 days, up to 30 days is considered to be normal. In New York, we've been having clear to closes within 20 days. However, people aren't ready. The sellers aren't ready to move out. Sellers aren't ready to vacate the property. So we basically have a clear to close file, and we're just sitting there waiting for the house to be vacated. So it could take 60 days. It could take 90 days. It's because the attorneys just keep going back and forth and negotiating on things. And it's become a common and normal practice in New York to close 60 or 90 days.
Right.
So banks have the capacity to close much quicker than the contract really allows for in New York. But again, it all depends on what state you're going to be doing.
Right. Okay. That makes sense. How are you seeing buyers apply for loans differently? Are they paying more for down payments since the interest rates are higher? Are they buying all cash? Like, what are you seeing?
Also depends on the market. If you're looking at the New York market, depending on where, depending on the buyer, we're still seeing 30, 40% down payment to qualify for a certain type of a program. Outside of New York, I've been starting to see a lot of different type of loans come up with smaller down payments. So people that weren't able to buy 7, 8 months or a year ago because they were just constantly overbid by somebody else, now they have the opportunity to buy. So if you're a 3% down payment buyer, if you're a VA buyer, and I love VA buyers because you have to do 0 down payment, and it's pretty much 99.9% chance guarantee that you're going to close. So those buyers didn't have an opportunity to buy before because they were number 25 on a list.
Right.
The sellers all wanted to see 25, 30% down payment because that was the norm. So today we are seeing the smaller down payments. We are seeing the people that couldn't buy before coming out of the woodworks and like, okay, we want to buy a house. Hey, we only got 3% down payment. Help us buy. So
We're
we're
doing a
seeing
deal like
a
that
lot of
right
that.
now as well. So
Yes.
I get it. Those buyers were not able to purchase 6, 12 months ago because the competition was too fierce, but now those people
Correct.
are getting an opportunity. Okay.
Yes.
All right. I don't think I have any other questions, Robert, unless there's anything else that you want to mention or you think that's important in terms of what viewers want to hear in terms of mortgage and purchasing and projecting for the future.
Tell me about you. How are sellers at a market like this? What are sellers? How are you getting sellers to sell, and where are they going? Are sellers, because if you sell a property, you have to transition to another property, right?
Yes.
You have to be buying something else. So you're seeing you still have a ton of listings. You're seeing sellers move. Are interest rates scaring them? What's
So the sellers that I'm seeing in the marketplace that actually sell right now are kids selling from parents who've passed, people that are been in the house for a long time. They have a lot of equity and they're either moving out to Long Island. They're going to still sell their house for a high price in Queens, or they're moving to Florida and they're going to be all cash buyers. Or people, we're not getting, or the people who are upgrading, who are moving up, right? Like people who the market might be a little kind of softer now, so they're selling for a little bit of a softer price, but they're buying in the same market, right? Like they're buying and selling in the same market, so it doesn't really affect them a whole lot. Those people that bought in the last 2 years, 2-3 years, they're not selling for a long time, because why would they, right? Like those people, first of all, they just bought, and second of all, they have such a low interest rate that they wouldn't be, some people probably wouldn't be able to afford to buy something today if they sold. So those people I think are going to stay put for a while, but there's still a lot of people who are, you know, selling, but not as many as we did have, but those are my main sellers that are actually listing their homes these days that want to sell.
And you're doing great. I keep seeing new listings come up, new listing. Maureen has done it again. Maureen has done it again, another listing. So it's amazing. And for the viewers that are watching, if you're not in New York or if you're not in Florida, reach out to us anyway. We'll help you. We have
We'll
a
point you
great
in the right
referral
direction.
source.
We've got contacts and a network of agents and loan officers that will help in all different states that be able to help you
Absolutely.
achieve your real estate goals and dreams. And yeah, thank you so much, Robert, for joining. I appreciate it. And
Thank you,
make
Maureen.
sure you, I'll share your contact details, but just tell them how to find you on Instagram.
Yes, on Instagram, robert.mortgage. It's the quickest way. If you need to reach out to me, 718-969-7171. And I'll provide my email as well. But whichever question you have, whatever it's in regards to real estate, if I can't do it, I'll direct it to somebody, same with Maureen. And it's a passion. We want to help people. We want to get you into a house, because still today, there's no better investment than real estate. The stock market won't do it. Crypto definitely will not do it. There's nothing that you could put your money into that will grow and be a protective asset like real estate. So
Yeah.
we really hope that if you haven't bought yet, don't wait.
Yes.
Do it. Build your own equity.
Love it. All right, Robert, thank you so
Thank you so much, Maureen.
And we'll be in touch.
Thank you.
Bye.